Good day, folks. Welcome to the final lecture in this series. We talked about the data visualization to be able to see that it's used in decision making. I just want to go through a couple of finer points of this. One is that this entire cost volume profit analysis depends on a couple of key assumptions. The first one is total sales and total cost can be represented linearly with straight lines. Okay? Second is within the relevant range of operating activity, the efficiency of operations does not materially change. Okay, that's all those charts we've been seeing have been based on this, and that you can divide cost into fixed and variable components. The sales mix is constant, and the sales, no change of inventory during the period. So these are sort of all assumptions that are made. And when we are going through analytics, the assumptions are generally stated. Some of them are obvious, but we always want to put down what our assumptions are as we move forward. We've been focusing on very singular companies that produce a single product. But many companies, in fact, most companies, have more than one product, and sometimes the same product at different selling prices and sizes, etc. So you can only imagine how complicated this can get. The examples we're going to use in this course are going to be the fairly simple ones, but you need to be aware that it's much more complex than we're seeing. And here's a sense right here. This is Pepsi, and besides making Pepsi, they also do Mountain Dew, but they also go Tostitos, Lay's potato chips, Cheetos, the Tropicana orange juice. There's a lot of different things, iced tea, water, that they produce. Each one of them has a different selling price, has a different variable cost, fixed cost, and a different unit contribution. So as you move into much more complex companies, you're literally going to build this from the ground up, product by product. Okay? Each one of them is going to have their unique analysis like we showed for one product. And the break-even analysis can still be performed, but it's going to be across the board, okay? And it's going to be a broad-based one so that, remember, decisions can't be made at a high level. Pepsi can't make a high-level decision here. They have to look at each component, each thing they do, each product. So we say the sales mix is how it's distributed amongst the company, what makes up these percentages. And if we look at, here's just another simple example, product A and product B. They have total fixed cost of 200. In this one, product A, which makes a unit contribution of 20, they sold 8,000 of. And in this one, they sold 2,000 with a unit contribution of 45. So when we take the total, we can find out that the mix is 80-20, and we show that. Okay. Now, what the hell? Oh, there we go. For break-even analysis, it's useful to think of the individual products as components of one overall product in the firm. The unit selling price of the overall enterprise equals the sum of the unit selling prices multiplied by its sales mix, weighted, essentially. Likewise, the unit variable cost and unit contribution of the overall enterprise equal the sum of the unit variable cost and unit contribution margins. Multiply its sales mix. So all we're doing is taking the individuals, which was the starting point of each product, and we're weighting them together to come up with a break-even analysis for the company. And you could see that in this example. We set it at the break-even point at 0, and we drive it back. Next simple concept it's not simple, is we have operating leverage and financial leverage. Financial leverage is how we have used our mix of debt and equity to lever the company up, magnify. So with financial leverage, what we have is we're using other people's, we're using a mix of debt and equity to produce the highest return to the shareholder by levering up. So we might use, the best example of this, or trying to explain it to you, is that if you can borrow money at 3% and you can make 6% on it, you're magnifying that investment. Okay, so you're making money on the debt, making money on other people's money. Now, if your debt is costing you 3% and you're only making 2%, you're not benefiting from that leverage. So that's financial leverage, which is the use of equity and debt. Operating leverage, on the other hand, is related to what we're talking about. It's the relationship between the contribution margin and income from operations. So we're looking at how have we leveraged these fixed expenses, essentially. And we use the terminology operating leverage. And that is the contribution margin divided by income from operation. The difference between the contribution margin and income from operations is fixed cost. So thus, companies with a high fixed cost will normally have a high operating leverage. Okay? And when we look at that, it's how are we looking at fixed costs versus variable. If most costs are fixed, don't decline when demand falls, then the firm has a high operating leverage. Okay, so we want to know, is the firm using a high operational leverage? Okay, and because if demand falls and we don't have that income coming in, it's going to accelerate, magnify, if you will, our loss. But on the other hand, is that if it is highly leveraged, a small percentage increase in sales can produce a much larger percentage increase in net operating income. It goes both ways, and it's a balance. Remember, it's a function of the numerator and the denominator. So we really want to say how sensitive net operating income is as a percentage of change in sales. Here's just another example of two companies. This company here has Jones. Yes, they have 80 fixed, but we can see that they're more leveraged. Okay, 5. And a 2 for Wilson. They have lower leverage. So what we're going to see is that an increase in sales at Jones will magnify the return. However, if it goes down, the opposite occurs. Same thing with Wilson. If the variable cost, and this is a matter of scale, okay, and it's often used to measure the impact of changes in sales on income from operations. And using operating leverage, the effect of changes in sales on income can be seen as percentage change in income from operations, which is percentage change in sales times the operating leverage. So we can see at that time that we're going to see a leveraging effect.